Welcome to the Deep Dive. We're here to crack open complex reports, find the real story hidden inside. Sometimes that picture's crystal clear. Other times, well, it's surprisingly blurred.
Exactly. And today, we've got a fascinating case study that really highlights this contrast. Synaptogenix Inc. That's ticker XNA, as NPX.
Right. We're going deep into a comprehensive stock report from Trendline on Synaptogenix. It mashes together financials, ownership, technicals, the whole lot.
And our mission today is basically to pull out the most important bits, the key takeaways, to really understand why this company, it's in the pharmaceuticals and biotech sector, presents such a contradictory picture.
It really is a puzzle, isn't it? As of July 1st, 2025, the stock price was $7.85. And get this, it was already up 30%.
Yeah, quite a jump.
But, don't let that initial pop fool you. As we peel back the layers in this deep dive, you're going to find it's a real mixed bag. So let's get into it.
Okay, so first up, just a quick bit about Synaptogenix Inc. itself. It's a biopharmaceutical company, and their main thing is developing a product platform based on a drug candidate called bryostatin.
Bryostatin. And the big focus, the most advanced work, is clinical testing for Alzheimer's disease.
Yeah.
Which is, obviously a huge area of need.
Absolutely massive. But they're also looking at bryostatin for other neurodegenerative conditions, cognitive diseases too. The report mentions Fragile X syndrome, multiple sclerosis, and Niemann-Pick type C. Those are still in preclinical testing, though.
Okay, so a potentially promising drug candidate. Now, to really get a handle on how this report assesses the company, we need to understand their framework, right? The DVM scores.
That's it, DVM. It stands for durability, valuation, and momentum. Think of them as like three different lenses for looking at the stock.
Right. So how does Trendline define those, and what's a good score look like?
Okay, so durability, that's about fundamental strength. Consistent growth, good cash flow, stable revenues, profits, not too much debt. Anything above 55 is considered pretty strong there.
Got it. Durability is strength. What about V-valuation?
Valuation tells you if the stock's a bargain or maybe if its strengths are already kind of baked into the price. So is it expensive? A score over 50 here is generally seen as good, meaning potentially not overpriced.
Okay. And the last one, M for momentum.
Momentum looks at the stock's short-term trend. Is it bullish? Is it bearish? It reflects buyer demand, technical signals, market sentiment. Here, a score above 59 signals a bullish trend.
And this is where it gets really interesting, like you said, because the report shows this huge gap, this divergence between these three scores for Synaptogenix.
Exactly. It looks completely different depending on which score you're looking at.
So where should we start? Maybe the financials? The durability?
Let's start there with the financial landscape. Because, frankly, it waves some serious red flags right away. Synaptogenix Inc.'s durability score. Well, it's listed as not eligible.
Not just low, but not eligible.
Right. It's not even getting a rating on that scale, which, immediately suggests some pretty deep underlying financial weaknesses. A high score usually means consistent health, so this is, yeah, it's a big hint.
Wow. Not eligible. That really says something, and I bet when we dig into the actual numbers, it gets even clearer.
Oh, yeah. The picture gets starker. Profitability, returns, they're deep in the negative. The PE-TTM, price to earnings trailing 12 months, is minus 0.9.
Negative PE.
Yep. Return on equity, the annual percentage, is a massive minus 89.8%.
Minus 89.8. Wow.
And return on assets, ROA, that's also negative, minus 55.5% annually.
So these aren't just small negatives. An ROE near minus 90%.
Yeah.
That sounds like the company is just burning through shareholder value at an incredible rate.
It absolutely is. It means for every dollar owners have invested, the company lost almost 90 cents in the last year. Their net profit annual is negative $12.8 million. And the net profit TTM growth, minus the 168.6%.
Oof. What about revenue?
Total revenue annual is just listed as a dash, which the report says is low in the industry. Book value per share is $3.00, noted as below industry median, and no surprise, zero dividend yield.
Okay, so a lot of negatives there. Does the balance sheet look any better? Or does it kind of tell the same story?
It reinforces that story of contraction and increasing burdens. The report points out that total assets annual, total shareholders funds annual, and working capital annual are all falling faster than historical averages.
How much faster?
Well, as of December 24, year over year, assets were down 43%. Shareholder funds plummeted nearly 76%. Working capital shrunk by 36%.
76% drop in shareholder funds.
Yeah.
While assets and working capital are also falling sharply. That's That's pretty dramatic shrinking.
It is. And here's the flip side. Total liabilities net minority interest annual is actually growing higher than historical averages. It was up 98.2% year over year as of December 24.
So the core company value is shrinking fast, while the debt is basically doubling.
That's the picture it paints. A shrinking core, a ballooning debt burden.
And cash flow. Is there any relief there?
Not really. Cash from operating activity annual is negative $4.9 million, and its growth is lower than historical averages. Cash from financing annual activity is negative $5.1 million, falling faster than historical averages.
So money's going out from operations and financing activities. What about the net change in cash?
Also negative. Net increase in cash plus cash equivalents annual was negative $11 million, also falling faster than historical averages. It's a pretty clear picture of cash challenges across the board.
Okay, so negative profits, negative returns, shrinking assets, rising debt, negative cash flow. It seems overwhelmingly negative. Is there anything positive in the financials?
Well, this is where it gets a little strange. Amidst all this red, there's one single outlier metric that looks really good. Their EPS, QTR, YoY growth percent, that's earnings per share, quarter over quarter, year over year growth. It's at 129.3%.
Wow, 129% growth. How does that fit with everything else?
It stands out, doesn't it? The report notes it as high in industry. It's a real curiosity, this one positive spark against, well, a very dark financial backdrop.
Huh. So if we zoom out and look at the trendline checklist for financials overall, what's the verdict? How many boxes did they tick?
For the financial section specifically, 0. 0 out of 8 criteria met.
0 out of 8.
Yep. It means no consistent profit or sales growth, no high durability, high debt rather than low, weak ROE, negative cash flow. Basically, a clean sweep of no answers on the financial health checklist.
Okay, so durability is a definite no-go, deep financial issues. But if the company is struggling this much financially, how is the market valuing it? Yeah. Let's talk about that valuation score. This is where the contradictions really start to bite, right?
They really do. The valuation score for Synaptogenix is just 8 out of 100.
8 out of 100. That sounds bad.
It is. It puts it squarely in the bad category, signaling an expensive valuation. A score that low basically says whatever strengths the market thinks it has, they're already more than priced in. The report calls it popular but pricey. Definitely not a bargain bin stock.
And has it always been like this? Or is this a recent thing?
Nope, it's been consistently expensive according to this score. The report explicitly says the valuation score has been stuck in that bad zone 100% of the time over the last year, from July 24 to June 25.
A whole year of being rated as expensive. How does that compare to, say, other big pharma companies?
It's actually quite striking. With its score of 8.2, Synaptogenix has the lowest valuation score among its major peers mentioned in the report. We're talking Eli Lilly at 26.0, Johnson & Johnson at 38.8, Novartis at 38.0.
So it's considered more expensive than giants like Lilly and J&J, even with those terrible financials we just discussed.
Based on these valuation metrics, yes. Which really makes you wonder, doesn't it? If it's weak financially and it's rated as fundamentally expensive, what is driving the interest?
Yeah, what's the appeal? Does the trendline checklist offer any clues on valuation? Like, is it in a buy zone based on historical measures?
No, the checklist confirms it's not in the buy zone based on historical PE or price-to-book ratios. The overall valuation score just doesn't signal affordability at all.
Okay, so let's recap. We've got undeniable financial red flags, 0 criteria met on the checklist. And we've got an expensive valuation, lowest among peers, stuck in the bad zone. Logically, you'd expect the stock to be, well, struggling.
Absolutely would. But prepare for the plot twist.
I was waiting for this. Let's talk about momentum.
This is where the whole picture just flips. Synaptogenix has a momentum score of 81 out of 100.
81. That's huge.
It's huge. It's classified as technically bullish. So despite all those awful financials and the expensive tag, the stock is seeing massive buyer demand. The technicals are flashing strong bullish signals.
That's quite the contrast. Has this momentum been building?
It seems so. Over the last year, it's spent over 15% of the time in the good momentum zone and nearly 60% in medium. And here's another kicker. With that score of 81, Synaptogenix has the highest momentum score among those same peers, significantly higher than Lilly at 42.2 or J&J at 34.3.
Highest momentum, lowest valuation, terrible financials. What a strange combination. What specific technical indicators are driving that high momentum score?
Well, the report shows it's trading above all 8 simple moving averages, SMAs, and all 8 exponential moving averages, EMAs.
All 16 moving averages.
All of them. That's a really strong sign that the recent price action is consistently beating historical averages across different time frames, just broad-based buying pressure. It's also trading above 7 out of 9 oscillators in the bullish zone.
Okay, that sounds overwhelmingly bullish. Are there any cautionary signs within the technicals?
There are a couple of things to note. The day RSI, Relative Strength Index, is at 77.1, and the day MFI Money Flow Index is at 79.0. Both of those are generally considered overbought.
Overbought, meaning it might be due for a pause or a pullback.
Exactly. It suggests the recent run-up has been very fast, maybe too fast, and it could cool off short term. However, other indicators are still very bullish. The day MACD is positive and above its signal line, confirming the upward trend, and it's trading above its pivot level of 7.11, which is seen as support.
And how is this translated into actual returns for investors?
Pretty spectacularly, actually. The one-year return is listed at 91.5%.
91% return in a year with those financials.
Yep. The price volume charts clearly show that recent upward surge hitting that $7.85 mark we mentioned earlier.
So the trendline checklist must reflect this bullishness too, right, on the value and momentum side?
It does. 4 key criteria were met there. The momentum score itself shows bullishness. It's trading above all the short-term and long-term SMAs, and the candlestick patterns are bullish, or at least not bearish. It's a very strong technical picture, just completely at odds with the fundamentals.
Okay, so a technical juggernaut, fundamentally challenged. Let's pivot to ownership. Who actually holds this stock? Does that give us any clues?
It might. The shareholding summary from May 2025 is pretty revealing. Retail investors, listed as others data, make up the vast majority. We're talking 98.7%.
98.7% retail. Wow! So it's overwhelmingly held by individual investors, not big institutions.
Largely, yes. Which can sometimes contribute to volatility or momentum-driven moves, you know?
Makes sense. What about the institutions and mutual funds that do hold it? Any changes there?
Very slight changes. Mutual funds increased their holdings, but just barely, from 1.27% to 1.28% in May 2025. Institutional investors' holdings stayed exactly the same at 6.16%.
So not exactly rushing in, but not fleeing either. Who are some of the named holders?
The report mentions big names like Vanguard and State Street among the institutional holders.
Okay. And how did the ownership picture look on the trendline checklist? Did it meet many criteria?
It did reasonably well there. It met 3 out of 4 criteria on the ownership checklist.
What were those?
Those included things like mutual funds or institutions buying shares in the past quarter, promoters either buying or keeping their ownership stable, and the overall holdings by MFs or institutions rising over the past year.
Okay, so some positive signals from the ownership side. What about insider trading? Sometimes that can be revealing.
Yeah, there's an interesting little wrinkle there. The checklist summary asks if insiders have not sold stock recently, and the answer is no, which, if you read it literally, implies insiders have sold recently.
Oh, okay. So insiders might be selling.
Well, hold on. When you actually look at the detailed insider trading table in the report, it shows recent activity in April 2025 was directors getting grants or acquiring shares at $0 likely stock awards. The last actual sales by directors at a market price seemed to be way back in December 2022 at $1.17 a share.
So the checklist summary might be a bit misleading there.
Yeah.
Recent activity was zero-cost acquisitions, not market sales.
Exactly. It really highlights why, for you, the learner, it's crucial to sometimes look beyond the simple checklist answers and dig into the underlying data. A subtle but important distinction.
Good point. Okay, so let's try and pull this all together. We've gone through durability, valuation, momentum, ownership. What's the final overall report card from this trendline analysis for Synaptogenix?
The overall trendline checklist passed 44.4% of its criteria, which is, less than half.
Less than half. And the main sticking points were?
Definitely the financials. That complete failure, 0 out of 8 criteria met, is a huge red flag. And then the expensive valuation, with that incredibly low score of 8, those are the big areas of concern.
But then you have the other side of the coin, the undeniable strengths.
Right, that incredibly strong, technically bullish momentum, scoring 81 out of 100.
Yeah.
And some, reasonably positive ownership trends, like institutions slightly increasing their stake.
So how do we connect these dots? What does it actually mean when you have a company with such clear fundamental financial problems, negative profits, shrinking assets, rising debt, but at the same time, it's showing this incredibly powerful market momentum and delivered a 91% return over the past year.
It's the core contradiction, isn't it? It suggests the market, or at least a significant portion of it, is potentially ignoring the current financial reality and focusing heavily on something else. Maybe it's future hope for bryostatin. Maybe it's pure technical trading. Maybe it's speculative interest amplified by that high retail ownership.
And compared to its peers, it really stands out. We recapped it before, but it's worth saying again. It's rated the most expensive on valuation, yet has the highest momentum.
A true outlier. A study in contrast, really. This deep dive into the Synaptogenix report has definitely revealed that compelling contradiction. Challenging fundamentals versus undeniable market momentum.
So for you, the curious learner, looking at this report, it paints this really vivid picture, doesn't it? A stock seemingly driven much more by technical signals, maybe speculation, rather than traditional financial health or, current business performance.
Absolutely.
And this raises a really important question for you to think about. When you're faced with these kinds of conflicting signals, the deep financial woes versus the powerful market sentiment, how do you weigh that? How do the potential long-term prospects of a biotech company, especially one with a drug like bryostatin for Alzheimer's, still working its way through clinical trials, stack up against its current, quite frankly, poor financial state and this hot momentum?
Yeah, how might this very specific, very mixed blend of information guide different approaches if you're a fundamental investor looking at those financials versus maybe a technical trader looking purely at the charts and momentum? They'd likely come to very different conclusions, wouldn't they?
Something to definitely mull over.
Yeah.
A fascinating, contradictory picture indeed.